So today we're going to be looking at OKTA, what I think about them, their future, and that sort of thing. So we're going to start off on Robinhood, move to TradingView, and then move over to Simply Wall Street. So actually starting on Robinhood, I currently have 9 shares of OKTA. I bought them back in, I believe, January 2019 and December 2018, so around January then. So looking at the value now, it is June 17th, 2020. They're currently valued at $192. Back when I purchased it, it looks like it's around $68. So you can see the difference there, going from 68 to 192 in that time. With that, I purchased 2 different times, but I've had a total return of over $1,000 and 180%, which is great. Going down, so what actually is OKTA? They're an identity management platform for different companies. What they actually mean is they encrypt data and they actually protect people's passwords. So as everything becomes increasingly digitized, everything increasingly online, there's more of a need for them, and that explains their rapid growth. They were only founded in 2009, so that kind of gives you a little bit of background. Analyst rankings or ratings, I really don't look at these too much. I mean, buy 65%, hold 30%, sell 4%. I think eventually, kind of the summary of this video is that they're overvalued. I'll show you that towards the end. But I currently do not think you should buy them right now. I think they're way, way overvalued. So that's all for Robinhood. We'll move over to TradingView. Looking at TradingView, I took OKTA, which is now using candlesticks because I think it gives a little more information about the stock, the highs and lows of the day, and overlaid with the S&P 500. Obviously, with coronavirus, it dipped down around, I believe it was like March 13th was around the lowest day for the stock market, and then it bounced back. The S&P bounced back to about 8%, whereas OKTA is now around 51%. This is over 1 year, so ROI over 1 year. And you can see this is up to date. It says 192.71. This is 192.66, so this is all up to date. But you can actually see the difference in the return on investment overall. And they give a little more analyst ratings here, but again, I don't really follow those. And then what's also good about TradingView is you can go down and look at headlines, so what kind of news they have. They also have that in Robinhood. Where are the articles? I believe you can find articles about OKTA as well, but I also don't look at those too much unless it's from a third party. So lastly, we're going to finish off with Simply Wall Street. I think Simply Wall Street's the best site of the three because it gives the most in-depth ratings, why they do it, and they analyze things and break them down. How they break them down, they use the snowflake. So this is this 5-pronged valuation tool for every single stock. So the future and health are good. Keep in mind, OKTA was founded in 2009, so they're not going to have much of a past there. The dividend, we'll get more into that, but I don't think they give out dividends, if I'm correct. And the value it's way overvalued. And they give you a little bit more of a summary here. So revenue, it's about 23% per year. I mean, that can vary, but that's just their idea. This is really cool, the share price and news. So they have 4 different categories here. Any sort of financial news, management news, strategy, change in strategy, or other. And there's also changes in leadership. So if you go down to 3 months, you can see really, March 13th was the bottom of the market. So you can see the product updates. They came out with a couple, and they're really shooting up. So that's why, due to great management, I think they're doing really well. 7-day return, that's not going to tell you very much. 1-year return, 42%. That's fantastic. Being a technology company, they are in the IT sector. So the United States IT ROI is about 13%, whereas the U.S. market's about 5%. IT was not hit very hard from the coronavirus just because everything's online. So it's not like some brick and mortar building that was hit heavily. The valuation, this is really cool. They are currently overvalued according to Simply Wall Street by 150%. I think it's less than that. If it was up to me, I'd say their stock market price should be around 100, 120 because I think they're a great company. They have great management. They think fair value would be 75. I think that's undervalued, but they think it's about right. But I mean, this hasn't been updated yet. So maybe this was yesterday, the week before. They said it's only 188. It's 192.88 roughly. So that needs to be updated. But the big takeaway here is that it's way, way overvalued. Probably by 100%. 150 is kind of pushing it. Price to earnings, really not going to tell you too much. I did want to scroll down to the future growth and expected growth. They're expected to hit about 2.2 billion. I don't know if you can read that in blue by the end of 2025 in 5 years. And there's their earnings at negative 235 million. So the future growth forecast for the industry is 25%. This is the IT sector. Keep that in mind. It just says IT. The market's about 23%. So that's just the U.S. market in general. So IT is expected to do well, and they're down there. But the annual revenue growth, they're at 23%. IT sector is at 11%, and market's at 9%. So they're doing a lot better. There's that. Earnings per share, who knows in 2023, you can see actually the low and high of what analysts think, and there's a lot of differentiation here, so they're not really sure. But it's expected to go up ever so slightly into 2025. They don't forecast beyond that for Simply Wall Street just because it's too far out. And if you want to look at the particular data, the numbers they suggest, you can look at it here, but I'm not going to go into that. See, there was one other thing I wanted to go over. Assets, liabilities in the long term, it's going to be about 403 million, and liabilities going to go up to 1 billion. I think they're still in that growth stage, that rapid growth. We're kind of more of an aggressive company. That's why they're overvalued. Looking at the balance sheet, you can see the cash. It's about 1.4 billion, and you can see their debt's around 1 billion. So it looks like they're taking out a lot of loans here. And, just to actually confirm that, you can scroll up and you will see, the management, financial, things like that, really in the last year, just to confirm that. And there's a lot of them there. So that just confirms they're taking out a lot of loans in order to make that rapid growth. Let's see what else here. I did want to go over the CEO or just the management. So the CEO is currently 47 years old, which is pretty young, and he has a $9 million compensation. I don't think he's going to go anywhere, so that's good. You don't really want to change in management too much because that's going to probably negatively affect the stock price. So this is good. You can see his compensation, it's going up and up and up, which is great because it means he's going to stay on, and hopefully they're going to increase that stock price even more. And if you want to go through the leadership, you can. I'm not going to go through that. But the average age is about 47 years old, so they're not young and inexperienced, but they're not too old where they're going to age out around 60, 65. So there's a lot of time here for them to grow as a company and grow that company culture as well. And you can look at the ownership, but that's all I really want to touch on today. I want to touch on so today we touched on the actual price, when I bought it, why I bought it. We touched on the S&P 500 and overlaid it with S&P 500, and we saw that it's going up rapidly. And then we talked about why it's going up rapidly, and its weak points, the value, the dividends in the past, but it's highlights the future in health. And that's everything for today.